Our action reflects two main factors. First of all, the federal debt ceiling was suspended in the middle of February in a timely manner for a duration of over 12 months and in a way that avoided casting uncertainties over the full faith and credit of the United States, in contrast to the episodes we saw in October last year and August 2011. Secondly, the US public finances have been improving markedly since we put the US on negative outlook at the end of 2011. The general government debt to GDP ratio we believe will peak this year at 100%, which is below the threshold that we previously identified as being incompatible with a AAA rating for the US. And our judgment remains that the US's debt tolerance remains stronger than any other country in the world, owing to the unparalleled financing flexibility of being the issuer of the world's preeminent reserve currency and benchmark fixed income asset, and that hasn't been diminished by the debt crises. Well, when we think back to October last year, at the height of the debt ceiling crises, we saw yields at the short end of the curve increase, credit default swap spreads rise, and some investors being reluctant to hold short-end treasury bills as collateral. We also saw some pretty strong statement by the US's biggest creditors, both domestic and foreign governments, suggesting that they would reassess their willingness to hold US government debt. But in the event, we've since seen US Treasury bills return to previous levels, and we've seen foreign holdings of US securities increase in every month between September and December last year. So we don't see evidence that there's been any damage to the US cost of funding, the role of the US dollar, or the willingness to hold US government securities. Well, we're seeing a strong fiscal consolidation in the US. We expect the budget deficit to be below 3% of GDP this year. That's down from 6.7% just 2 years ago and nearly 10% in 2009. And we expect government debt to GDP to peak this year at 100% and then to decline for the next few years. And that's well below the levels that we expected when we put the US on a negative outlook back in 2011. It's true, though, that the government debt to GDP ratio is likely to increase again towards the end of the decade, owing to the pressures from an ageing population on health and social security spending, as well as higher interest payments. But those long-term projections are more uncertain. And although we don't expect a grand bargain in the near term, owing to the political atmosphere, it's possible that there could be some measures on tax and expenditure reform in the future when the political environment is more conducive and the pressures on the deficit are more intense.